All right, are we good? Can everyone see?
Yes.
Yeah.
All right, great. So yeah, hello everyone. Welcome to this session on roadmap for getting started with investing, which will hopefully be of value to anybody who's kind of looking to learn the fundamentals of investing and get started. Our agenda is to look at what your options are. More specifically, we're looking at stocks, index funds, bonds, and cryptocurrency, and then we'll kind of get into how to start a portfolio and actually get started. If you have any questions along the way, feel free to drop those in the chat. We'll try to pause and get to those. But otherwise, we'll also have a Q&A session at the end for any investing related questions. So before we start off, I want to talk a bit about myself, introduce myself to all of you. I'm from the Seattle, Washington area, and I'm an upcoming junior at Eastlake High School. I actually started learning about investing at the age of 8. And at the age of 11, I bought my first stock, which was Bank of America. And since the stock was still pretty slammed by the Great Recession back then, it has done pretty well. But in terms of teaching, investing has always been something that I'm passionate about and passionate about spreading to others. And so 2 years ago, I actually held an 8-week investing course in person at my local library. And last year, I also taught a 10-week virtual investing course. On top of that, I've also built up a successful school investment club, which we continued this year virtually. And that was a lot of fun. And we got to spread investing to a lot of people. And lastly, I've also more than tripled my portfolio in the last 5 years, which represents a compounded annual growth rate of about 21%. So yeah, that's a bit about me. But with that said, I want to get into why investing even matters. So let's take a look at the data from the past 50 years. Let's say you saved $500 a month for 50 years into a high yield savings account, which gets you about 0.5% return annually in the current macro environment. That would amount to about $30,000 to $40,000 at the end of your 50. So that's a pretty good sum, but it's probably not retirement money. Instead, though, if you invested that $500 a month into the US stock market, that would amount to a whopping $7 million. So how do we get this massive number? Well, the US stock market, which in this case representing by the S&P 500, which is a group of the top 500 companies in the US, has historically delivered an average return of about 10% annually. So as businesses grow exponentially, so does your capital as an investor. But it's not a perfect exponential curve up. Here's the actual graph of the S&P 500 between 1971 and now. So you can see that over here we had the crash of 1987. We had the dot-com bubble over here. We also had the Great Recession, and more recently we had the COVID-19 pandemic crashing the stock market as well. So we had all these different crashes, but still over this 50-year period, the stock market as a whole has compounded by large amounts, specifically 10.78% annually. And so in the past 50 years, the 10% historical average is actually an understatement of your actual returns. $500 a month into the S&P 500 since 1971 would actually be worth about $9.3 million today. So the conclusion here is that investing is important and that by making your money work for you, you can build up a large sum of wealth over a long period of time, which can allow for things like financial independence and a stress-free retirement. And if all this still isn't enough to convince you on investing, your money is actually losing value constantly over time when it's not invested in growing. Here's a chart of the value of $1 over time. So a value of $1 that started at $1 goes all the way down to about 20 cents after 50 years. And that's because of the constant decrease in purchasing power, which is caused by things like population increases and other factors. And this effect becomes exponentially worse in countries with higher inflation rates. So for example, India has an average inflation rate of about 8% compared to 3% in the US. So in India, the value of 1 rupee that would have started out at 1 rupee would have decreased to only 0.02 rupees after 50 years. So if you're living in a country with a high inflation rate, investing becomes even more important so that you can protect the purchasing power of your money. A lot of people say, you know what, I'll start in a couple of years. I'll worry about this investing stuff when I'm older, or I'll think about this later. But the facts are that even waiting as little as a couple of years can significantly decrease the growth of your money. So to get a better understanding, let's look at this table. On the left, we have the starting age and amount, and on the right, we have the hypothetical amount at retirement or age 65. So $10,000 at the age of 15 will become $1.2 million at the age of 65, assuming a 10% annual return. But then at the age of 20, this decreases to just $700,000. At the age of 25, it's only $400,000. And at the age of 30, it decreases to $300,000. So you see that just a 5-year delay between 15 and 20, or really any 5-year time period, when you first get started, costs you a whopping $500,000 when you're putting $10,000 in. So starting as soon as possible is very, very crucial. Of course, whether you start today or tomorrow doesn't really matter because the market's usually a roller coaster in the short term. But you don't want to, investing is not something you want to put off for multiple years. So, do you have any questions about this first slide about why investing matters?
No questions. We can continue on to the next slide.
All right. So now with that out of the way, let's get into what your options are. So investing as a whole isn't just limited to the stock market. In fact, there's many different investments that you can put money into that can grow over time. These are formally known as asset classes, and 8 of the most popular ones are: number one, you have stocks where you invest in a business. You have funds where you invest in a group of businesses, real estate where you invest in land and property, CDs which pay interest similar to a savings account. You also have bonds where you lend money to a borrower, commodities where you invest in raw crops and materials, cryptocurrency where you invest in digital tokens, as well as foreign exchange where you invest in paper currencies. However, a lot of these don't actually make the best investments. For example, it's extremely hard to make money in Forex, where you see a lot of people doing things like day trading. And in commodities, these are stationary assets that just sit there and don't make money like actual businesses, and therefore they won't really compound over a long period of time. And CDs really aren't much better than a savings account in terms of the return you'll actually get. Real estate is something that can work out really well, but the work and the time commitment that's involved isn't something that's for everyone. And so the 4 assets that you see a lot of investors pouring money into are stocks, funds, bonds, and cryptocurrency. And those will be the main ones that we'll be taking a deeper dive into today. All right, so starting off with stocks, stock really represents ownership in a company. So if I own stock in a certain company, that would mean that I own a piece of that company and I'm entitled to my fair share of profits. On screen here is a bunch of examples of pretty large companies in the market. You have names like Google, Facebook, Amazon, Apple, and Microsoft in big tech. And you also have names like Bank of America, Wells Fargo, Southwest Airlines, Square, Roku, etc. And all these are examples of specific stocks that you can invest in. In total, there's about 40,000 publicly traded companies around the world. So there will always be good opportunities in the stock market and no shortcomings in terms of the choices you have. All these companies together make up more than $85 trillion in value. The vast majority of this comes from the US, with the New York Stock Exchange being worth about $26 trillion. And the NASDAQ is also worth about $19 trillion. And you also have about $13 trillion in total coming from both of China's stock exchanges, about $6 trillion coming from Japan, $4 trillion from India, and then the rest is coming from a bunch of other countries. But the prices of these companies fluctuate constantly throughout the day because of buying and selling activity. In shorter time frames, it's almost impossible to predict where the stock price will go next because there might be some unexpected news which hurts the company. But over a long period of time, a well-performing business whose profits are also growing will increase in value, and so will the stock price. On the flip side, you have a poor-performing business whose profits are on the decline, and that will probably decrease in value, as will the stock price. So really, when you're buying a stock, you want to be betting on the future potential of the underlying business. In general, you have 3 different categories in which people like to kind of categorize stocks into. These are value, value, and growth. Value kind of refers to companies that are consistently able to produce profits, but they don't really grow at very fast rates. Usually it's between 3 and 10%. Meanwhile, growth value kind of refers to companies that are consistently able to produce profits, but also grow by pretty good amounts that usually range between 10 and 25%. And then lastly, growth refers to companies that aren't consistently profitable, but they're growing at very, very fast rates that are above 25%, and they're expected to be profitable sometime in the future. Value stocks are generally more conservative because all their value is being presented now, and they're not growing much going forward. While growth stocks are more aggressive and risky because there's not much value now. Instead, you're kind of paying for what's possibly coming in the future. A lot of investors prefer one of these categories because it matches their style. But value just refers to the more slow, stable businesses, while growth names are much more volatile and risky, but can come with potentially more upside. As a whole, the benefits of stocks are that they're productive businesses, have large upside potential, and they also beat inflation. Companies are always producing money in the background. Sometimes you can find a hidden gem in the market, and the average 10% return of stocks as a whole far exceeds the average US inflation rate of about 2 to 3%. However, the problems include being risky in small numbers, the fact that research takes time, as well as market volatility. It doesn't happen often, but sometimes you can see stocks go down over a long period of time or even go bankrupt. This could be due to a number of things, including insanely high prices to begin with, poor management decisions, or a declining demand in the industry. But this is why in depth research is so important when investing in individual stocks. And that can take quite a bit of time to do. So, as a whole, stocks are kind of this high risk, high reward investment that you can get pretty good upside on as businesses grow exponentially over time. So, do you have any questions about stocks?
No questions, Vineel. Very well articulated, good articulation of asset classes and explanation of stock ownership. Very good going so far. Thank you.
Thank you. Okay, so now moving on to index funds. This is kind of like investing in a group of businesses in just a single purchase. So what happens is you kind of give money to an institution, which then invests that money into a predetermined set of companies. So when you sell your stake, the institution sells the appropriate portion of all the different businesses and then passes you on the cash. So for example, let's say we have an index fund called the Big Tech 5 Index Fund. And this fund invests in a predetermined group, aka an index, of 5 big tech companies, which are Apple, Microsoft, Google, and Facebook. And they invest in the following proportions. They put 30% in Apple, 20% in Microsoft, 20% in Amazon, 15% in Google, and 15% in Facebook. This fund comes with a price that represents the value of its underlying positions. So if Apple increased 10%, while all the others decreased 2%, the index fund price as a whole would still be up because the gain in Apple outweighs the other losses. If an investor wanted to invest in big tech companies as a whole, they could invest money into this index fund, and the institution running it, which could be Vanguard, Fidelity, Schwab, BlackRock, SPDR, T. Rowe, or some other management firm, they would take the money and spread it across all the different components in the appropriate proportions. So this is a win-win for both parties. The investor can easily gain exposure to big tech without having to go and buy each individual stock. And meanwhile, the institution who's managing the fund gets to profit off a small fee on all the investments. Of course, the investor could go out and buy all the stocks themselves and avoid the fee, but this becomes increasingly difficult when you have indexes with thousands of companies which represent entire stock markets. So as an example of an index and index funds, the S&P 500, whose performance we used in the chart in the beginning of this presentation, is a group of the top 500 companies in the US. And it's probably the most popular index that investors want to invest in. And so there's multiple institutions that offer index funds that invest in all the components of the S&P 500 for a tiny fee. For example, here you have the Vanguard 500 index fund, which is managed by the institution Vanguard, and they charge a 0.04% expense ratio. You also have the Fidelity 500 index fund by Fidelity, and they charge a 0.015% expense ratio. And lastly, here's the Schwab S&P 500 index fund, which is by Schwab, and they charge a 0.02% expense ratio. So all the charts here look just a bit different because they were first offered at different times in the 2000s and 2010s, but they pretty much move by the exact same amount every single day, and they all have extremely small fees. But the difference is, unlike stocks, index funds don't trade on a stock exchange, and the price doesn't fluctuate throughout the day. For example, here's the 1-month chart of VFIAX, or the Vanguard S&P 500 Index Fund. You can see that the price only updates once every day. And that's because index funds don't trade publicly. Instead, it's more like you give money directly to a company who then invests that money into the components of an index. And the price is just updated daily at 4 p.m. Eastern Time to reflect the value of all the components. So this is where what's known as ETFs come in. ETFs are kind of like special index funds that trade in the public market, and the price fluctuates throughout the day. And like stock, the price is based on supply and demand. So while you can see the VFIAX price chart on the left is only changing on a daily basis, something like the Vanguard S&P 500 ETF, which is under the symbol VOO, has the exact same trend, but the price is constantly fluctuating. And a couple of other examples of this would be something like IVV, which is by BlackRock, and by SPY, which is by SPDR. But in all three of these ETFs, you can see that they have the exact same trend, but unlike the index fund, you have these ETFs are trading on the public market, and the price is fluctuating constantly based on supply and demand, rather than just updating daily based on the actual value of the components. So yeah, is there a question?
So there's a question in YouTube. So that
Yeah.
so the question is, what types of stocks should you consider? Should you center your portfolio on?
Yeah, that's a great question. And I think the answer really depends on your investing style. If you're kind of dividing stocks into value, and growth, value is kind of more for conservative investors who want to invest in more slow, stable businesses, while growth is more for people who want to invest more aggressively and want to invest in more high risk, high reward investments. So if you're more young and you're fine with the risk, I think growth is probably more well suited for you, while value is probably better for someone who doesn't want to take on that much risk and just wants the more stable, established businesses in the stock market. You can also see stocks divided into many other types, like by sector, by cyclical, or the penny stocks, etc. But it really depends on what you want to invest in and what your style is. In terms of what sector you want to invest in, that's completely personal preference in terms of what sectors you think are going up in the future. But in terms of value versus growth, I think it's a question between, are you a more conservative investor who wants to invest more conservatively, or are you a more aggressive investor who wants to invest more aggressively? So I hope that kind of answers that question. But yeah,
Thank
do you
you.
have any other questions?
So there's another question which is from the chat, and it says, I'm wondering the pros and cons between the mutual fund versus ETF for tax saving and any other.
Between mutual funds and ETFs, I think mutual funds, they're more actively managed. So as opposed to index funds, where you're investing in a predetermined group of companies, a mutual fund, you have an actual fund manager who picks stocks on behalf of the investors. The problem with mutual funds is the fees can be very, very high, like 0.85%. And the difference doesn't seem very much, but that can make huge differences in the long term. So that's the first problem with mutual funds. In terms of taxes, mutual funds, because they're so actively managed, you see them making a lot of transactions. Every couple of months or even every couple of weeks, they'll start buying and selling their positions. And that causes capital gains. So every time they sell for a profit, they'll have to pay capital gains. So generally, mutual funds are less tax efficient than an ETF or an index fund. so you'll probably receive more distributions and more capital gains. So the short answer would be mutual funds are less tax efficient and are probably not the best choice just because of the high fees and the fact that they've underperformed index funds over the past 15 years. So yeah, I hope that answers the question.
Yeah, Vinil, everything you said is right on. One more thing I would like to add is that ETFs also automatically rotate in and out based on their rules, but they enjoy the government's special provision of in-kind exchange. So there is no taxation when they do in-kind exchanges within the fund. For example, S&P will take out 25 companies every year, put some 25 new ones. On the ones that are taken out, there is no tax consequence because it's an in-kind exchange.
Right, that's interesting.
Yeah.
All right, so are there any other questions? If not, we'll move on.
Yeah, no other questions at this point.
All right, so yeah, let's get into the pros and cons of index funds. So some of the concerns, some of the
There's one other question that came in.
are that.
Oh, sorry, one other question that came in just now. So, so the question is that I heard mutual funds are safer than ETFs. Is that true?
I wouldn't say so. Mutual funds and ETFs are both, I guess, under the bigger category of mutual funds. The only difference being that most ETFs are passively managed and they just invest in a predetermined group of companies, whereas with mutual funds, they're managed by an actual person who goes and picks stocks on their behalf. In fact, I would go as far to say mutual funds are more risky just because it's an actual person picking stocks and they're very actively buy and sell different positions, whereas ETFs are kind of just like a buy and hold type of strategy. So I wouldn't say one is more risky than the other. It really depends on the actual fund. For example, a growth index fund that focuses on investing in growth stocks would be more risky than a value-oriented mutual fund, and vice versa as well. So I think it more so depends on what the fund is really targeting. But yeah, with that said, the biggest benefit of index funds as a whole is diversification. So essentially, you're no longer betting on a single company to perform well. Instead, you have the entire basket. So if one out of the 500 companies in there goes bankrupt, the entire value of your investment is almost unchanged. And in addition, you don't need to do much research before investing. So unlike a stock where you dig deep into a specific company to see if it can do well moving forward, when you invest in a broad selection of stocks like the US stock market or the technology sector, you really only need to be convinced on these broad markets appreciating in the future. You don't have to do that deep dive that you'd really do with individual stocks. However, the problems of index funds or the concerns would include the fact that they have average returns, there's a lack of flexibility, and sometimes there can be high commissions. So just like index funds prevent a degree of risk because of their diversification, that can also prevent high upside. So if one stock out of the group goes up a lot, it'll barely have an impact on your position as a whole. So your investment will just ride along with the average returns of whatever market or industry the index fund is investing in. So if you're investing in the technology sector, it's just going to be the average return of the technology sector. If you know that one of the stocks inside the index fund is going to do really well, you won't be able to capitalize as much on that upside. Second thing, in terms of lack of flexibility, because index funds invest in a predetermined set of companies, you cannot switch any components out quickly if you see that one of them isn't doing that well. So if you're investing in individual stocks, you can buy and sell whenever you want. But when it's in an index fund that's managed by an institution, predetermined indexes only change every couple of months. So if you see a company really that doesn't fit anymore, you can't swap that out very quickly like you could in a mutual fund or an individual stock. Instead, you have to wait potentially a long time for the actual index to change. So as a whole, index funds are a great balance between high returns as well as decently low risk, and you can get them for pretty low fees nowadays. In terms of commissions, I forgot to talk about that, but commissions only apply to some index funds at some points. For example, if you're buying a Fidelity index fund from Fidelity's investment platform, there are no commissions because you're buying it directly through them. But if you're going to go and buy Fidelity's index fund from Vanguard, then you might have to pay something like $20 to $50 commission when you buy and sell that index fund. But this is completely waived for ETFs, so it's something you can sometimes face, but it's not always there. So do you have any other questions before we move on?
Yeah, no questions at this time.
All right, so now the next investment we have is bonds. And a bond is essentially a loan where you're lending money to someone and that person pays you back that sum plus some more over time. For example, let's say we have this investor, let's pull up the investor, and let's say this investor is lending money, this amount of money to an institution for 5 years. So in year 0, the money goes from the pocket of the investor to the pocket of the institution. On year 1, the investor receives the first interest payment. On year 2, he receives another interest payment. Same on year 3, same on year 4, and same on year 5. And after year 5, the original sum is also returned back to the investor. So the investor is able to get some nice passive income over a 5-year time period, and the institution gets to borrow money that they needed. So that's kind of how bonds work in general. It's a win-win for both parties. But in general, you have 3 different types of bonds, which are based on who investors are lending money to. For example, treasury bonds are bonds issued by the US government, which means that if you buy treasury bonds, you're lending money to the US government. Corporate bonds are issued by companies, which allow businesses to fund their operations through debt. And then lastly, municipal bonds are issued by states or cities to fund public works projects like roads and bridges. The benefits of investing in bonds as a whole is that they're generally low risk and they're stable and predictable and generate passive income annually. In terms of risk, reward, and volatility, bonds are pretty much the exact opposite of stocks. They're low risk versus high risk, low reward versus high reward, and stable versus volatile. The problems, though, is that there is a chance of default, meaning the borrower may go bankrupt, and in that case, they won't be able to pay you back. But the chance of this happening really depends on who you're lending money to. Something like the US government is very trustworthy, while lending to a declining business may have significant risks if they end up going bankrupt. So some very, very high risk corporate bonds could be, to some companies that are about to go bankrupt or generally declining businesses, maybe airlines or movie theaters or something like that, would be very, very high risk versus the US government has pretty much never failed to repay a bond in its history. The other problem is that right now the interest rates you'll get on bonds are very, very, very low because of the Federal Reserve slashing their rates following the COVID-19 pandemic. As an example, here's some of the most recent interest rate data for US Treasury bonds. So for a 10-year period, you're only getting about 1.5%. But even before COVID-19, you'd only get about a 2 to 3% return. So going back to the pros and cons, the last problem is high taxes. All interest payments are considered short-term capital gains. So you pay regular income tax rates on all your interest payments. And that's much worse compared to the reduced tax rate that you can get with stocks and other assets if you hold them for more than a year. So for example, the highest tax bracket, you might be paying almost 40% tax on your bond income versus only about 23.8% on your capital gains from stock. So that higher tax rate also has a pretty negative impact on your return with bonds after tax compared to stocks. So overall, bonds are kind of this low risk, low reward investment that can provide just a bit more return than a savings account. So do you have any questions about bonds?
Yeah,
Hey,
one
Vineel.
question is, go ahead.
Vineel Balama here. Just the one clarification that bond interest, it is in a way like short-term capital gain from a taxation rate point of view, but it does not enjoy the benefit of offsetting short-term capital losses. Okay, so if you have short-term capital loss and if you have interest from the bonds, you can also offset the two of them together. The interest you earn from bonds, you have to pay ordinary income taxes.
Yeah, that's one. And the second thing is that like if somebody gets a dividend
Yeah.
from a stock holding, it enjoys a lower taxation rate.
That's right.
It's a federal tax rate. I don't know if the states impose their own taxes. They may
Right.
on the dividend income, but generally speaking, dividend income is taxed lower. And I think above certain rate, certain level, there's a separate tax as well. But still, even if you include that, today it's still lower than your ordinary income tax. I think this tax kicks in at I think around $400,000 or $450,000. I'm not 100% certain about the amount, but there's a slightly additional tax, but it's way uh, lower than the ordinary income tax that you would pay at those incomes.
Yeah, the dividend is dividend
Right.
becomes qualified after you hold a security for 90 days. So you get that 15 to 20% tax rate after what is called as the qualified dividend, right? If it is not qualified, then it becomes like ordinary income.
Exactly. I think that's a good distinction to make between real estate investment trusts as well, which you don't have qualified dividends there, so you have to pay regular income tax. And also, I think bonds, if you sell bonds, if you sell the bond themselves for capital gains on the secondary market, considering it's been a year, you can also get long-term capital gains on that too. So yeah. Do we have any other questions? All right. So if not, the last investment we have is cryptocurrency. And cryptocurrency is essentially a digital token which is backed by blockchain technology. So each coin has a unique digital signature, and then you have miners who are verifying transactions through a variety of methods, and they receive rewards for doing so and keeping the crypto running. By establishing a trustless network that verifies transactions, you remove the trusted middleman that has traditionally been necessary to mediate these types of things. And so this technology has the potential to remove or reduce the fees of a lot of different services. The largest cryptocurrency, as well as a lot of other cryptocurrencies, use a concept known as proof of work to verify their transactions. So here you have miners who are putting in computational work by solving complex math equations in order to verify transactions. So whatever has the most computational work behind it is trusted. And so somebody wanting to verify a false transaction would have to have more than 50% of all miner computing power, which for large cryptocurrencies can be very, very expensive to acquire. The problem here, though, is that all the computational work takes up energy. And so some cryptos have moved to what's known as proof of stake. And here you have miners who are selected randomly based on how much of the cryptocurrency they own. So in order to verify a false transaction, the attacker would have to own more than 50% of the token. But an attack wouldn't be in the interest of somebody with that kind of ownership because the price would plummet thereafter. So in this way, proof of stake is kind of less energy consuming and also potentially more secure than a proof of work method. Some of the largest cryptos out there include Cardano, Bitcoin, Dash, Dogecoin, Ethereum, Litecoin, and Ripple. And all these are pretty different in their use cases, maybe with the exception of Dogecoin, which was created as a joke. But the point is that, like stocks, crypto is an investment that would require a lot of research before diving in. So they want to fully understand the coin's purpose, its use cases, its future opportunity, its potential risks, etc., and then come to a conclusion on whether the risk-reward profile is something that's worth it for you or not. The benefits in general of investing in crypto are that it's an early and innovative technology, which may potentially mean a potentially very high future upside, although that does come with significant risk. And then you also have the fact that it's decentralized to an extent, which could lead to some industry disruption when middlemen are removed from the picture. But the problem is that crypto is an unproductive asset, which means, unlike a company, it's not constantly producing money in the background and making your money work for you. Instead, it's kind of like simply betting on a chance of a token gaining more demand moving forward. It's kind of like also the commodity where there's no actual intrinsic, it's kind of a commodity in that it's just sitting there and not actually producing money as with a business where you have businesses making money and sometimes passing on the income to you, or bonds where you're actually getting paid income, or real estate where that can also appreciate and earn income over time. So crypto kind of just sits there like commodities. And like I said, it's kind of like betting on a token getting more demand moving forward, rather than kind of betting on the future prospects of a business. You also have things like speculation, ultra high volatility, fees, fraud, and more. There's a lot of useless coins being made that don't add much value, innovation, or use cases, and these skyrocket in price just for the memes. For example, recently there's this coin called DeFi 100, whose founders ran away with investor money, and they displayed a message on the website saying, "Haha, we scammed you." And so there's a lot of sketchy things in the industry. And as a whole, crypto is something where you only want to invest money that you're going to lose, because although there may be tremendous upside in the future, there are some fundamental issues like government regulation. So crypto is kind of like this ultra high risk reward investment that it could prove very good if you've done your research and you have very, very high conviction in a specific cryptocurrency. But the research, like stocks, would take some time. So are there any questions about cryptocurrency?
So there's a comment about bonds. Which I just wanted to highlight. So the thing is that, like, this is from Amit. He says that regarding bonds, the safety for investors. So bonds enjoy preference over equity if the company goes into liquidation. So there are so in a company's security structure, so there are like various levels of preferences, and even for bonds also, like there are different. There's a different hierarchy. So when the company goes into liquidation, the people, the creditors get first preference. That's in the US, and then it goes all the way down, and the stockholders are at the very tail end, meaning after everybody else gets paid off, only then the stockholder will get paid off. So because stockholders are considered as business owners, and they're at the so they take the highest risk as well in case of a liquidation. So there's a good comment. I just wanted to highlight that.
Right. So even if you see a company go bankrupt and get restructured, you still lost all their money no matter what. In most cases. So
Yeah. So there's one question. So like, so the question is about what type of app would you recommend for all forms of investing? So this question comes from YouTube.
I think we're actually going to talk about this in a bit in the presentation here. So I think I'll hold off on that until then, and I can probably expand on that once.
Okay. So there's another question. This is on crypto. So the question is that, could you please explain again why decentralized or decentralization is a pro for crypto?
Right. Basically, no cryptocurrency is fully decentralized because you have centralized miners, centralized exchanges. But the benefit of decentralized for crypto is that you can kind of remove the middleman who has traditionally been needed to mediate different services. So, for example, in the banking industry, you might need you need the bank to kind of mediate the transactions and everything. And with something like Bitcoin, you have nobody there to mediate. So that decentralization has the potential to remove or reduce the fees of a lot of different services. So I think that's the main benefit of decentralization. The other benefit would be that there's no control in one specific party, although we're seeing crypto become more and more centralized. And basically, there's always going to be a part that's centralized to crypto. But I think those two would be the main benefits for decentralization. Are there any other questions?
Yeah, no other questions at this point.
All right. All right, so those were 4 different asset classes in which you can invest.
One other question has come in just now.
Right.
So it says, would you say the type of investment depends on the individual's risk-taking capacity? Meaning, like, so that is the question. So I have a follow-up question that is like, so I'm a person who doesn't want to take a whole lot of risk. I just want to save, and over a period of time, I want to become wealthy. And there's always this notion that like if you get into the stock market, there's inherent risk. So is that true? That's my follow-up question. The first question is that, so is there a type, meaning is every type of investment, is there a dependency on person's risk-taking capacity?
100%. There's it depends on your risk tolerance, and we'll talk more about that later, very soon, actually. So, of course, if you're less comfortable with the risk, you want to go with more conservative investments, maybe value stocks, maybe maybe that's bonds. If you're more aggressive and you're perhaps more okay with the risk, you could consider more growth-oriented stocks, more cryptocurrency, and more the high-risk spectrum. But in terms of inherent risk with the stock market, I think when you're investing that something like the S&P 500, you have to think about, what's the worst case scenario? And the worst case scenario is that it goes to zero. But if you actually think about how something like that could go to zero, if the top 100 companies in the US were to go to zero, then there's no banks, there's no Apple, there's no Microsoft, there's no big tech, there's no Google to search on the web anymore. Pretty much all the services and products you know today are no longer. So if you really think about the US stock market going to zero, that's practically impossible. If that were the case, then your cash would also be worthless without any banks. So I think the whole stock market crashing over a long period of time is something that's very, very unlikely, just because of this fact that humans need services and products which are delivered through these businesses that sell them. So, of course, there's in the short term there will always be risk in the stock market specifically. Of course, we had the crash of COVID-19, but over a long time, we've seen this historically over centuries, and also just thinking about it intuitively, the stock market tends to grow over time. So I wouldn't expect something like the S&P 500 to go down more than about 40% in a single time, or it's happened like only once in history. So in the short term, there will always be risk because of these market fluctuations, but in the long term, at least in the stock market as a whole, there's not much risk in that manner. But something like if you're betting on an individual stock, there's a lot more risk if the actual company goes bankrupt.
Okay, we can.
So yeah, with that said,
yeah.
So those are 4 different asset classes in which you can invest in, which are stocks, index funds, bonds, and cryptocurrency. And once you have a good understanding of what your options are, you want to start thinking of how you want to structure your portfolio. So portfolio is essentially the pie chart of where you're allocating money and how you're going to invest it. So for example, you might want to do something like an all S&P 500 portfolio, and you dump everything into the US stock market, which is kind of the simple, boring, yet proven way to build wealth over time. So for example, of what you could invest in to achieve this include VFIAX, which is an S&P 500 index fund offered by Vanguard. You could also go with the ones offered by Fidelity or Schwab. But all these allow you to invest in the S&P 500. It's kind of the simple way, the simple strategy to compound your money over time. But other people like to do what's known as the 3-fund portfolio. And here the majority is invested in US stocks, another portion is invested in international stocks, and the smallest portion is invested in bonds. So this is a bit on the safer side, but it can also come with lower returns. And examples of what you could invest in to achieve this include a combination of VTI, VXUS, and BND, which are US stock market, international stock market, and bond market index funds offered by Vanguard. Or if you wanted to go with Fidelity, you could go with FCORX, FCILX, and FTBFX, which are, again, US international and bonds index funds provided by Fidelity. And these first 2 here actually are 2 of the only index funds in the market that have no expense ratio or fees whatsoever. They make money by trying to attract customers to the rest of their services. But these 2 combinations are both examples of what you could do to achieve this type of portfolio. And then lastly, some people like to do a split between individual growth and dividend stocks. So growth stocks are the big capital gainers that are growing at a fast pace, while dividend stocks are the income payers that pay you a nice amount every quarter in dividends. So the split kind of allows for the best of both worlds. For example, some examples of growth are PagerDuty, Google, AMD, Spotify, or Etsy. And some examples of dividend would include Ultra Group, AbbVie, Realty Income, Pepsi, or Lockheed Martin. So you're kind of going 50-50 growth and dividend. A lot of people like to do the split, or just invest in these growth value companies that kind of merge these 2 things together. But outside of style, risk tolerance is another factor to consider when you're building a portfolio. So generally, risk tolerance decreases as age increases. And that's because younger people have time to withstand the volatility and downturns of the market, while older people may not be able to withstand that because they may be focused on preserving wealth for retirement. And so investors may invest more conservatively or more aggressively depending on their age. And actually doing this, changing a portfolio as you get older, is known as a process called rebalancing. For example, a dividend growth investor may start more aggressively at the age of 30 with about 80% in growth and 20 in dividend. And then at the age of 45, transition to about 50-50 split between growth and dividend, and then go more conservatively at the age of 60 and go to more 70 dividend, 30 growth. And a three fund, someone who's investing in a three fund portfolio might start more conservatively again with 60% US, 30% international stocks, and only a small portion in bonds. And at the age of 45, transition to 20% bonds. And at the age of 60, go way more conservatively with the massive 60% in bonds. So this method kind of shifts your portfolio as your potential risk tolerance is going down. But following this method isn't for everyone. So if you're comfortable with the market swings and you want to keep things simple, sticking with a similar portfolio composition or just going with the flow as you grow older is a strategy that can also work pretty well. So do you have any questions about structuring a portfolio?
Yeah, no questions at this point. But
Right, so
yeah, I want to make one point about structuring a portfolio. So the thing is that, like, if you look at like investors who are pretty well known. So most of these people, they don't shift their investing styles or investing portfolio over age. So even Charlie Munger, who is 97 years of age, is mostly into stocks, not so much into bonds. So they're more opportunistic. So so one has to like look at the thing, and like also there has been a case study from P.D. Brown. So this was a lady. So she got widowed. I think I don't remember her exact age, maybe in her 50s or 60s, and she followed the investment advice and put the money into bonds. This is around Second World War time frame, and after 20-30 years of time, like the bond returns were like not that high, and like the portfolio value went down. So then she had to depend on social security and other things. So one has to like keep in mind, because like people will tend to live very long these days, and like because of the advance in modern medicine, people can live quite long, and with the low interest rates in the bonds over a period of time, it can lose the purchasing power. So that's something to keep in mind. So there's also one question that came in meanwhile. So what it says is that, do you have data points on how did the three portfolio turned out? S&P 500 only, 3.4 portfolio, and 50-50 growth over a period of 30-year window.
no, I don't have any specific data on that, but I can tell you that S&P 500 has compounded by 10.78% annually for the past 50 years, which will turn about $10,000 into 9.3 million over that 50 years. In terms of a three fund portfolio, you might see more like a probably 7 to 8% return historically, because that bond kind of weighs down, although that comes with lower risk. The 50-50 growth dividend, it's kind of hard, or there's not much statistics on that, because it really depends on the index funds you choose to represent that. There might also not be data going back too far, but I'd expect it to be pretty similar to the S&P 500, just because S&P 500 is also made up of both growth and dividend as well. But yeah, I don't have any specific data points on that. But yeah, so once you're ready to get started with investing, you have three main ways of going about it.
So there's another question which has come in. So it basically says like there's a pointer to a back testing portfolio, which will allow you to test it out to see how these things did over the past 30 years. So there's a link to that in chat. And
That's definitely a great resource.
yeah, and Amit has also said like there's something called IUL, which gives some degree of safety, and there's also annuity, which he hasn't specifically explored much, but which does a standard payout every year. So there's a question from Raghav. He basically asked, like, when you say restructuring a portfolio, so he's assuming that you're picking a portfolio offered by an investment bank or like some institution. So individuals can only directly invest in a particular basket. Is that right?
No, when I'm talking about portfolios, I mean you personally investing in the different categories. So if you want a three fund portfolio, you could personally, I mean, the easiest way to do it would be to personally invest like 60% in US stocks, or if you want to make it easy, a US index fund. And 30% are international stocks. You could pick those yourself, or if you want to make it easier, just go and get the entire basket of international stocks with an index fund, and the same for bonds. Or three fund portfolio is very popular, so you have institutions that do that automatically as well.
So there are these funds called the target date funds. I mean, I think they do automatic rebalancing over a period of time. I think
Right.
without one having to bother about rebalancing by oneself. And also, I think it's typically these are offered in tax advantaged accounts. So I don't think one sees a tax impact of it. And there might be a like-to-like conversion, which may also reduce the tax impact.
Okay, so now once you're ready to get started with investing, you have three main ways of going about it. The first is through a financial advisor who is a real person that invests on your behalf and is obligated to make investments in your best interest. The downside here is that ultra high fees can get as high as 2% annually. But again, it's a real person who is managing your portfolio. You can also go with a robo-advisor, which is a series of computer algorithms that invest for you depending on the inputs you provide. So these have much lower fees, closer to 0.25% annually, but there is no real human being that's investing on your behalf. Then lastly, you have an online brokerage where investing is completely in your control, and you can invest in anything you want at any time. So the broker is simply there to connect you with different exchanges to execute the transactions. And there's no fees here, and absolute autonomy is in your hands. So this is definitely the best option for any retail investor who's willing to learn some of the fundamentals of investing. Like they say, you wouldn't want a doctor to control your health because you're the one who should be controlling your own health. So similarly, you wouldn't want a financial advisor to be controlling your finances. You want to be controlling your finances. So for pretty much all retail investors, I'd say online brokerage is probably the best option to go, just so that you're the one who's controlling your finances and able to do things in your best interest. So some of the popular online brokerages in the United States are Interactive Brokers, Fidelity, Charles Schwab, Robinhood, Vanguard, and TD Ameritrade. The big three, which are Fidelity, Charles Schwab, and Vanguard, all tend to be great choices for most long-term investors. All three of these have trillions in assets under management, and they offer a swath of different low-cost index funds. But Fidelity and Schwab do come with some added features like fractional share trading, as well as some more advanced trading platforms. The rest of these brokers are also pretty good, but Robinhood probably isn't the best to have as a main broker just because they don't have things like retirement accounts, and they're also comparatively have a low amount of assets under management. They only have about 20 billion compared to the trillions these big brokerages have. And they also experience pretty frequent outages and trading blocks. Famously, they restricted trading on a bunch of different stocks during the whole GameStop saga. And they've also had a lot of different outages, a lot of different problems as well. So Robinhood probably isn't the best choice as a main brokerage, although you could have it in addition to something else, and that could work out pretty well. But getting started with any of these brokers is a three-step process. So number one, you'll have to verify your identity and create an account with any of these platforms, which can easily be done through the website. Number two, your account, you want to fund your account with money from a checking or savings account. And number three, use the money in the brokerage account to make your investment orders and build up your portfolio. So it's a pretty simple three-step process to get started with investing. So we had a question about investing apps back then. I hope this answers it. These are kind of like different platforms, not apps per se, but almost all these, actually all of them do have mobile apps with them, as do most brokerages. So yeah. All right, so lastly, I want to talk about mindset. So the biggest mistake that beginner investors always make is related to mindset. So take this chart, for example. Over the long term, this stock has gone up by large amounts. But during this period, which is in the circle, which let's say is 5 years, the stock barely went anywhere. So this could have been because of some regulation concerns, flat market, or something else. But even if an investor still thinks the business will grow and be successful long term, it can be very enticing to sell and go jump on the next hot trend. not selling because of a problem with the business, but because the stock hasn't gone anywhere in 5 years. So in these types of moments, it's crucial to keep a long-term mindset and not be swayed because of where the stock price is going or not going. Then it can be even tougher to hold on during a period like this where the stock suddenly tanks by large amounts. For example, if this was a bank, consumer airline, or something else that got hurt by COVID-19, the impact is short term, and panic selling just because the price is down would not only lose you a lot of money, but also miss out on all the long term gains and the reason for why you bought the stock in the first place. In a lot of high growth companies like, for example, Peloton, Teladoc, Snowflake, etc., you can see 30 to 60% pullbacks when there's pretty much no change in the underlying business. And this just happens because some of the big players are shifting to other companies. And so again, during these times, staying calm and playing the waiting game is really crucial. The other mistake a lot of investors make is FOMOing into investments. FOMO stands for fear of missing out, and it's basically where you follow the hype and only invest in something because everyone around you is doing the same thing and the price is going up. And this is a big mistake, especially if you don't understand or believe in the underlying investment. Oftentimes, FOMOers get in at the very peak and lose a lot of money. However, if it's something where everyone's talking about it, but you've done your research and have conviction in the investment, then FOMO or investing makes sense. But a great example of FOMO is Bitcoin, where you see a large percentage of people investing in Bitcoin just because the price is going up and or because they're being pressured by a friend. Bitcoin may be a good investment, but the point here is that the people who put in the research before jumping in are almost always the ones that come out on top in the long term. So kind of controlling your emotions, both when in terms of having a long-term mindset, in terms of when the stock is either flat or gone down significantly, when you know the business is still solid. And number two is kind of not falling to this FOMO and just jumping into investments when everyone else are. So do you have any questions about this?
So there are a couple of one comment, one question. So the question is that which platform do you recommend for new investors, specifically for students?
I personally use Fidelity, so I'm kind of biased, but I'd say Fidelity, just because I think they have great support. They have fractional share trading more so than Charles Schwab. They also have a nice 2% back credit card if you're interested in that down the line. That could also be a nice add-on to add. They also have pretty much every service you'd expect from a big brokerage, some of the lowest fee index funds. I could go on and on about their features, but I think Fidelity is a choice you can't go wrong with. So that'd be my personal recommendation. Not financial advice though. But I think Schwab and Vanguard are pretty similar. They have pretty similar features, but they're just missing a couple. So really with those three, you really can't go wrong with any of those three brokerages. But yeah, I personally go with Fidelity.
So there's
you can open
question.
up a custodial account on there as well.
So there's another question that has come in. So can you please explain timing the market versus time in the market?
Yeah, that's a very famous quote. Time in the market means you're kind of buying and holding. So if you're buying S&P 500 and holding it for 50 years, you're putting time in the market. Whereas when you're timing the market, you're trying to find, when is the price going to come down and where can I buy at the very, very best price? And kind of waiting for the market to go down. You know what? I'm not going to invest in the S&P 500 now. I'm going to wait for it to go down. I want the best price. So kind of trying to time the best time to get in is like timing the market versus timing the market is just investing and just sticking with it. So timing the market usually almost always doesn't work out just because it's impossible to figure out when a market will crash or when a market will do this or that in short periods of time. I mean, at one point the market will crash, but it's impossible to know when. So that's why timing the market is it's just good to just start and keep your investments compounding, then try to find the best point to get in, which probably won't happen anytime. So that's kind of how that works.
Okay.
Yeah, so that brings us to the end.
So there's one comment as well. I just want to mention that. So like this is like regarding the previous topic. So there's also a lazy dollar portfolio. So that was a comment that was made. So there's a link into that in the chat. So one more question that came in. So like, what are the best places to make new investments during COVID? Are airlines a good option now, considering that they are at a historic low? How does the airline market vary during MAE. I don't know what MAE is, since we have seen a lot of airline mergers recently.
Well, a lot of airlines have reported actually past their pre-pandemic highs. For example, Southwest Airlines has kind of like crazy. I personally owned Southwest Airlines before, and I sold quite a bit just because it's higher than pre-pandemic levels. A big problem with airlines is a lot of uncertainty around business travel. We are seeing businesses come back and doing air travel, although I think domestic airlines, for Southwest, for example, are more favorable because the demand is coming back more quickly. International, not so much yet. And airlines are really wrapped up in a lot of debt right now, so I'd say it's probably a bit more risky. Although if you believe in a certain company and what it can do in the future, go ahead and invest in airlines.
So I want to add to
Yeah,
that comment from Raghav. So there has been merger and acquisition. So in the US, the number of major players has decreased significantly. So that's definitely one of the reasons I think why Buffett was attracted to this sector. But as COVID showed, I mean, that disruption was unexpected, and airlines were pretty severely hit.
All right, so we do a Q&A session at the end, so I'll leave the rest of the questions for then. But that brings us to the end of this presentation. But before we get into the Q&A, I want to quickly talk about a course that I'm offering this summer through my company, Investential. I think investing is a topic with so many different aspects, so it can be tough to grasp on your own. And it's also something that's not really taught in our school systems, which is why I've created this course for beginner investors who are looking for a comprehensive guide on how to invest and get started. So in the course, we start with the very basics and work our way up, and pretty much no prior knowledge or experience whatsoever is required. There's about 11 hours of content in the course, and we go into depth on a variety of topics that we either just touched the surface on or didn't go over in this session. The course also comes with quizzes and action items for every unit. So the quizzes are there to reinforce learning, and the action items give you real actionable tasks to complete in order to practice investing skills and get started. In terms of content, we cover pretty much everything you need to know about investing. We go in depth into stocks, like things like acquisitions, earnings reports, stock exchanges, etc. We also go in depth into 5 different types of funds, as well as investments like bonds, foreign exchange, certificates of deposit, cryptocurrency, real estate, commodities, all those different things. Plus, we take a deep dive into building a portfolio, different investment strategies you can use in the market, saving and budgeting, order types, actually making a trade, taxes, taking a deep dive into tax efficient investing, different tax advantaged accounts you can harness, and a ton more important content, which I probably don't have time to talk about. But really, it basically covers all the fundamentals and information that's needed to become successful with investing. So the course is priced at about $99, but after discount, it's $79, which is about $6 to $7 per hour of content. And that's much cheaper than almost every other online investing course out there. The course can also be taken from anywhere by anyone. It doesn't matter if you're a teenager, a college student, or an adult. Investing tends to be important at any age. And it's also on your own schedule because it's made up of video lessons and other components. But we still keep it interactive through our Discord server where you can ask questions, as well as progress bars and discussions and things of that sort. And lastly, 20% of our profits go towards wildlife and COVID relief efforts. So you can learn and also support those struggling with COVID, our oceans, forests, wildlife, etc., at the same time, which is nice. So how do you sign up? You can sign up and learn more about the course at our website, course.investential.com. Preview lessons, course curriculum, frequently asked questions, testimonials, it's all on there. And of course, you can also enroll and access everything on that website as well. The actual course contents release on June 28th at 8 a.m. PST. And when you purchase the course before then, you can use code JunePie to get $20 off. If you have any questions about this after the session, you can feel free to contact us at investentialmain@gmail.com via email or call us at 425-504-0731 via phone. So yeah, again, you can sign up for the course at course.investential.com if you're interested in kind of getting a comprehensive guide on fundamentals of investing, in depth on a lot of these topics, and also how to get started. But yeah, so with that out of the way, we now have a Q&A. So if you have any questions about what we covered today or about the course, feel free to ask those, and I'll try to answer to the best of my ability.
So there are 2 questions.
Yeah,
Would you be able to share the slides And the second one is that what's your contact again? I think please share your contact and slides like in the investing club Telegram channel.
Yeah, so the context are here again. It's investential help, sorry, not investential main, investentialhelp@gmail.com, or you can contact this email as well. Doesn't really matter, but you can contact that email, or you can call us at 425-504-0731. Yeah, that information will be posted as well. Yeah, you can feel free to contact with us with any questions there. And in terms of the slides, 100% we can post that as well as the recording. We'll post that as well. So yeah, they'll all be there. With any other questions, anything related to the course or anything about what we covered today?
So Vineel, Balamo again, what are your thoughts on leverage and borrowing on margin risks? Should people even come to looking into it, or should they completely avoid?
Yeah, that's a good question. Leverage is kind of where you, for those of you who don't know, leverage is kind of where you borrow a certain amount of money, and basically it kind of multiplies your gains as well as multiplies your losses if the investment were to go down. So basically, you're going much more high risk, high reward. The problem is, of course, you have to pay interest on all your borrowings as well. I personally wouldn't do it or recommend doing leverage. That's because it's a super high risk, high reward, and you also have to pay interest on that margin. But if you're super convicted into one specific name, you could consider trying margin out. Although there's a lot of scenarios where it can go terribly wrong, and that's the big risk with it. If your stock pick doesn't work out well, you could lose a lot of money, which is a lot of people go bankrupt by doing that. So if you're really convicted, maybe I think you could consider adding margin to a position. But in general, I think it's probably a good idea to avoid.
Okay, good answer. The what about you have any thoughts and comments about derivatives, which are options, also called options?
Yeah, I think options in specific have a lot of interesting. What was that?
Yeah, I mean, yeah, I was just saying synonymously between saying that you have any opinions on derivatives or options. Yeah, your answer.
Right.
Go ahead.
Yeah. So options, options specifically, I think have a lot of interesting use cases. I think there's two types. One is like you sell puts to get into a stock, or you sell covered calls to make some nice passive income, or you could go a bit more speculative and buy a call or a put if you think the stock is going to go up or down. I think buying options is probably pretty speculative unless you have a really good reason or a big thing that's gonna a big catalyst that's gonna either post good news or bad news for a stock. But I wouldn't put any money into these buying options that you aren't willing to lose already, just because it's so speculative and you pretty much lose everything if you don't guess right. But in terms of selling options, I think selling puts is a great way to get into stocks at a lower price. If you're not fully sure you want to get in, puts are a great option to do that. And covered calls are also a great option to income, but you have to be willing to, you have to be okay with all the different scenarios that can possibly pan out. So if you're selling covered calls, you have to be 100% okay. If the worst case scenario, you have to go and sell your shares. So I think it's in terms of buying calls. Buying options. It's something where you wouldn't want to put money that you're not willing to lose.
Mm-hmm. Good. So I don't know if there are no other comments or questions. I just want to reflect something. Then that is that. So we started our Jnanartha investing in various, like in a different form, like through Google forum and things like that, and then discussions 4 years ago. And Vineel, you are the youngest presenter that we ever had, and so much kudos to you. Not only like that honor, but the quality of the content, right? I mean, it's a very good content, and you did a good preparation and articulated it really well, and probably gets the gold medal for people in high school for this kind of presentation. So congratulations to you.
Thank you very much. I appreciate that.
Yeah.
So if there's any other questions in the YouTube chat or in Zoom, free to answer.
Yeah, there are no other questions at this point. So there's one question. So that's about any thoughts on REIT versus real estate?
Yeah, I think that question really depends on whether you're interested in real estate investing as a whole, like doing it yourself, putting in the time and the work. Some people really like doing that, and some people don't. If you're the type of person who really likes going out and doing like real estate, finding the best deals, that type of thing, I think regular real estate could work out really well if you're interested in that. But if you're not really interested in it, you don't really want to put in the hassle, the work. I think REITs are probably a really good option to get exposure to real estate without having to actually put in any work. So I think it really depends on your level of enjoyment for putting the work into that.
So I think there are also tax advantages or tax. So
Yeah,
if
for sure.
one goes through REIT, can you explain that a little bit?
In terms of REITs, there's not many tax advantages because their dividends are also not qualified. Your capital gains, long-term capital gains, do come at a reduced rate. But in terms of real estate tax benefits, there are some benefits like when you can borrow money, you can leverage and very easily grow that stuff. There's also some other tax benefits that I'm not fully aware of. But in terms of REITs, it's a bit less tax efficient than stocks, but they're probably more tax efficient than bonds. So you're paying long-term capital gains a lower rate on your capital gains if you sell the REIT, but you pay regular income tax on your dividends.
So there are a couple of more questions. So one question is that so how do you join the? How can one follow? Is there a club? Is there a mailing list? How can one follow with you? So that's the question.
Well, you can contact me or us at investentialmain or investentialhelp@gmail.com. You can also call me at the phone number, which is 425-504-0731. If you're interested in my course, you can also sign up for that. I'm not sure if you're looking for the Telegram channel or something like that, but there's the channel on Telegram.
Okay.
But if you have any questions or any follow-up, you can also contact us via email or phone.
Okay. So there's another question, which is like, how do you? Maybe you can talk about it. So you can talk about it based on your experience. How to make kids interested in money and in savings in general. Do you have any opinions, or like do you have anything to share on that front?
Yeah, that's a good question. I probably don't have that many insights, but I'd say probably talk your kids through your budget or kind of how you're spending money. That's probably a good first step to take. I think probably showing them the power of investing could probably help. How the S&P 500 has grown over time. I think a great thing to do is definitely open up a custodial brokerage account for them. That's pretty much the best thing you can do for them. Just start them out with a bit of money in a custodial brokerage account and give them like actual money to invest in. Of course, they won't have, you don't have to be worried about responsibility because you'll have full control over the account, but kind of letting your kid get a real experience of investing and making investment decisions. I think opening a custodial account or a Roth IRA, if they're making earned income, is probably a really good step to take as well. In addition to kind of talking about the power of investing, giving them a good introduction, as well as kind of walking them through your budget and keeping them in the talk there.
Okay. So I think no further questions at this point.
All right, so I think we can close off then. So yeah, again, I appreciate the opportunity. Thank you everyone for coming to this presentation, and I hope it was of value to anybody who's